studying your last two. I swim with tea when they turned in. The staring out to mute and can lend a pole that some kid died.
Let's begin with one of the most important concepts in first-year corporate tax preparation: the incorporation date. Although it may seem like a simple administrative detail, this single date determines when a corporation legally begins to exist and forms the foundation of the entire T2 corporate tax return. On the left side of the slide, notice the sequence of events. A business owner works with a lawyer to complete the incorporation process. The required documents are prepared and submitted to the government, which then issues a certificate of incorporation. This certificate is the corporation's legal birth certificate. In our example, the incorporation date is July 18, 2019. From that day onward, the corporation officially exists as a separate legal entity. Below that illustration, you can see the key corporate details for this example. The corporation is a Canadian-controlled private corporation, or CCPC. It was incorporated on July 18, 2019. Selected December 31, 2019 as its fiscal year-end, and this is its very first year of operations. These facts may look like basic information, but they determine many important tax calculations throughout the T2 return. Now move to the center of the slide, where we compare the incorrect setup with the correct setup. The red panel illustrates one of the most common beginner mistakes. Many new tax preparers automatically assume that every corporate tax year begins on January 1st and ends on December 31st. They enter January 1st as the start date simply because the corporation has a December 31st year-end. However, this is incorrect. The reason is straightforward. The corporation did not legally exist on January 1st. Since there was no corporation at that time, it could not have earned corporate income, owned corporate assets, or filed a corporate tax return. As a result, a fiscal year cannot begin before the corporation itself exists. This mistake can create serious consequences. Using an incorrect fiscal start date leads to inaccurate tax calculations. When the Canada Revenue Agency reviews the return, it can identify the mismatch between the incorporation date and the reported fiscal year. That often results in a reassessment, recalculated taxes, and an unexpected tax bill for the client. Now look at the green panel, which shows the correct approach. Instead of starting the tax year on January 1st, the fiscal year begins on the actual incorporation date July 18, 2019 and ends on December 31, 2019. This correctly reflects the period during which the corporation legally existed and conducted business. Although this first taxation year is shorter than a full calendar year, it is completely valid under Canadian corporate tax rules. In fact, short taxation years are very common for newly incorporated businesses. Starting the fiscal year on the incorporation date ensures that every later tax calculation is based on the correct reporting period. On the right side of the slide, notice how this information is entered into T2 tax software. In the first example, the user enters January 1st as the fiscal start date. The software identifies the problem and displays a warning that the fiscal year cannot begin before the incorporation date. After correcting the start date to July 18th, the warning disappears and the return is accepted. This demonstrates that even tax software expects the incorporation date and fiscal year to agree. At the bottom right, you'll see a summary of the common beginner mistake. Simply entering the wrong fiscal start date can trigger incorrect tax calculations, CRA reassessments, and significantly higher tax liabilities. It is a small data entry error that can have very expensive consequences. Finally, look at the banner across the bottom of the slide. This highlights the golden rule that every corporate tax preparer should remember. A corporation's tax year can never begin before its incorporation date. Whenever you prepare a first-year T2 return, the first step should always be verifying the certificate of incorporation and confirming that the fiscal year starts on exactly the same date. The key takeaway from this slide is that the incorporation date is far more than just basic corporate information. It establishes the legal beginning of the corporation, determines the first taxation year, and serves as the starting point for every calculation that follows in the T2 return. Getting this single date right is the first step toward preparing an accurate corporate tax return. Now that we've established the correct incorporation date, the next concept is understanding why the first taxation year is different from every year that follows. The key reason is that the corporation did not exist for the entire calendar year. Because of this, the first taxation year is shorter than 12 months, and many important tax benefits must be prorated. Let's begin with the timeline shown on the left side of the slide. The corporation was incorporated on July 18, 2019, and selected December 31, 2019 as its fiscal year-end. This means the corporation operated for only 166 days during its first taxation year, rather than the normal 365-day period. This shorter reporting period is known as a short tax year. The fact that the corporation operated for only 166 days has important tax consequences. The Canada Revenue Agency does not automatically grant a full year's worth of tax benefits when a corporation existed for less than a full year. Instead, many tax limits are adjusted based on the number of days the corporation was actually in existence. Move now to the center of the slide. This visual illustrates the overall concept of proration. A normal corporation has a full 365-day taxation year. In contrast, a newly incorporated corporation has only a 166-day taxation year. As a result, many annual tax limits must be reduced proportionally. This is why the graphic emphasizes that everything gets prorated. The first major area affected is the small business deduction, often called the SBD. Under normal circumstances, a Canadian-controlled private corporation may have access to a $500,000 small business deduction business limit. However, that full limit applies only when the corporation has operated for the entire taxation year. Because this corporation operated for only 166 days, the available small business deduction limit is reduced proportionally. Instead of receiving the full $500,000 limit, the corporation's available limit is approximately $228,767. This reduction has an important consequence. Income that exceeds the reduced small business deduction limit is no longer eligible for the lower small business tax rate. Instead, that portion of income is taxed at the higher general corporate tax rate. In other words, a shorter taxation year means that less income qualifies for the lower tax rate. The second major area affected is capital cost allowance, or CCA. Capital cost allowance represents the tax depreciation that businesses claim on depreciable assets such as vehicles, equipment, computers, and machinery. Notice the illustration showing business assets like a delivery van and office equipment. During a normal full taxation year, the corporation may be able to claim a full year's allowable capital cost allowance, subject to the normal CC rules. However, in a short first taxation year, only the portion relating to the active period of the corporation can be claimed. Since the corporation operated for fewer days, the available CCA deduction is reduced. A smaller CC deduction means that less expense is available to reduce taxable income. This leaves more income subject to corporate tax. Now look at the flow diagram on the right side of the slide. It summarizes how these two reductions work together. First, The corporation has a lower small business deduction limit. Second, it has a lower capital cost allowance deduction. Together, these two factors increase taxable income. Once taxable income increases, the corporation ultimately pays more corporate income tax than many beginners expect. This explains why first-year corporations often receive unexpectedly high tax bills. Many people assume that a shorter taxation year automatically results in lower taxes because the corporation operated for fewer months. In reality, the reduced tax benefits often offset much of that expectation. At the bottom of the slide, the professional insight reminds us that a short first-year tax period reduces the tax benefits available to the corporation. The important lesson is that the accountant must recognize every area that requires proration instead of assuming that normal annual limits apply. Finally, notice the summary banner across the bottom. The message is simple, but extremely important. First-year corporations receive prorated tax benefits, not full-year limits. Every time you prepare the first T2 return for a newly incorporated corporation, you should immediately ask yourself whether any tax limits need to be adjusted because of the short taxation year. The key takeaway from this slide is that a short first taxation year affects far more than just the reporting period. It directly reduces important tax benefits, such as the small business deduction limit and capital cost allowance claims, which can significantly increase taxable income and corporate tax payable. Understanding these proration rules is essential for preparing an accurate first-year T2 corporate tax return. In this final slide, we'll bring everything together by looking at the professional workflow that accountants follow when preparing a first-year T2 corporate tax return. While the technical rules we've discussed are important, avoiding costly mistakes depends on following a structured review process before the return is filed. Let's begin with the left side of the slide, which highlights the most common first-year filing mistakes. The first mistake is using the wrong fiscal start date. Many beginners automatically select January 1st as the beginning of the taxation year without checking the incorporation date. Since a corporation cannot legally exist before it is incorporated, this immediately creates an incorrect tax period and can affect every calculation in the return. The second mistake is ignoring the proration of the small business deduction. Some preparers assume that every corporation automatically receives the full annual small business deduction limit. However, as we learned in the previous slide, first-year corporations with short taxation years receive only a prorated business limit. The third mistake involves capital cost allowance, or CCA. Instead of adjusting deductions for the short taxation year, some preparers incorrectly claim a full year's CCA. This produces excessive deductions and increases the likelihood of CRA adjustments. The fourth mistake is assuming that tax software will automatically correct every error. Tax software performs calculations using the information entered by the preparer. If the incorporation date or fiscal period is entered incorrectly, the software simply calculates the wrong answer more efficiently. Professional judgment is still essential. The fifth mistake is filing the return without performing a final review. Skipping this review can allow simple errors to pass unnoticed, eventually resulting in reassessments, additional taxes, interest, and penalties. At the bottom of the red panel, notice the illustration showing a small mistake leading to a large CRA reassessment. This emphasizes an important lesson in taxation. A single incorrect date entered into the return can eventually result in thousands of dollars of additional tax and reassessment. Small errors often create very large financial consequences. Now let's move to the center of the slide, which presents the professional workflow. The process always begins with the certificate of incorporation. Before completing any calculations, the accountant confirms the legal incorporation date directly from the official documents. Next, the accountant establishes the correct fiscal year by ensuring that the taxation year begins on the incorporation date and ends on the selected year-end date. After confirming the reporting period, the accountant identifies whether the corporation has a short taxation year. If the corporation operated for less than 12 months, the exact number of days is calculated because this affects multiple tax calculations. The next step is to prorate the small business deduction based on the length of the taxation year. Once that adjustment has been completed, the accountant also reviews the capital cost allowance calculation to ensure that any first-year restrictions have been applied correctly. Only after these adjustments have been completed does the accountant calculate the corporation's taxable income and corporate tax payable. Finally, before submitting the T2 return, the entire return is reviewed one last time to verify schedules, disclosures, supporting calculations, and tax adjustments. On the right side of the slide, you'll see the professional review checklist. This represents the final quality control process before filing the return. The accountant verifies that the incorporation date agrees with the certificate of incorporation. The fiscal period is checked to ensure that both the start date and year-end are correct. The number of days in the first taxation year is confirmed. The small business deduction limit is reviewed to verify that it has been prorated properly. Capital cost allowance is recalculated using the correct first-year rules. Supporting schedules, including Schedule 1 and Schedule 4 where applicable, are reviewed for consistency. Taxable income and corporate taxes are recalculated after every adjustment, and all working papers and supporting documentation are retained for future reference and possible CRA review. Following this checklist significantly reduces the likelihood of errors and ensures that the corporation receives every tax benefit to which it is legally entitled without making unsupported claims. Finally, look at the banner across the bottom of the slide. It summarizes the entire process. Correct incorporation dates, proper proration of tax benefits, accurate calculations, and a thorough professional review all work together to produce an accurate T2 return and help the corporation avoid unexpected tax reassessments. The key takeaway from this slide is that preparing a first-year corporate tax return is much more than entering numbers into tax software. Professional accountants follow a disciplined review process that begins with verifying the incorporation date, applies all required first-year proration rules, carefully reviews every calculation, and confirms the accuracy of the return before filing. This systematic approach prevents costly mistakes and ensures compliance with Canadian corporate tax rules.